What's going on, guys? My name is Matt. This is Run Up the Score, and I'm an individual investor looking to build an indestructible portfolio to pass on to my kids. So it is the first of the month, and at the beginning of every month, I'm going to be sharing with you guys my 5 best ideas currently in the stock market, best investment ideas. This will just be a really high level, explain to you why I'm interested in these, why I'm following them. Usually, the habit I've been getting into more lately, following a business and like deciding if it's good, the economics are good, it has a lasting competitive advantage, and then I think ideally you'll identify those companies, put them on a list, and just watch them for when there's an opportunistic time to buy. So that's sort of my approach going forward. So I have a list of some, and I'll talk about one of them today, where the companies, the business model is just pretty indestructible. It's just like the price is not really what I want to pay. And then there's some that are like maybe a little bit outside of my typical investment universe, but the valuation's really good and the risk reward seems to be a little bit in favor of making the investment. So I have a few of those on the list today. So this is really just a snapshot in time, my 5 best investment ideas right now. My 5th best idea right now is Redfin. So RDFN is the ticker symbol. Redfin is a real estate technology company, I guess you could call it. I've used them a few times as a customer. I've bought a home through them. I have sold a home through them. What they offer, the primary offer, in my opinion, is the reduced commission sale of real estate. So really compelling, because say you have a $300,000 home, you want to sell it, you're going to end up paying 5 to 6%. You're going to be paying seller's commission and buyer's commission. Typically, at least in Georgia where I live, the seller pays both sides. So you're paying 5 to 6% on a $300,000 home. That's what? That's $18,000. So that's crazy. That's a ton of money. And the actual amount of work the real estate agent is doing, it's when you crunch the numbers on it, it doesn't seem like they're doing $18,000 worth of work, right? So that's where Redfin comes in. They offer reduced commissions. For selling a home, you can put it up and you can pay 1.5% seller's fees. Sometimes this has never happened for me, but you can get where the buyer is using Redfin, the seller is using Redfin, and then it's between 2.5% and 3% total fees. So buyers and sellers. So that's about half of what you pay for typical real estate services. They have a website that's very similar to Zillow where you can search for homes. It's nowhere near as high traffic as Zillow is. A few other things they're doing is they do the iBuying, which is they make an offer on your home. And in my opinion, there's a lot of companies that do this. There's Open Door, there's OfferPad, I think is the other one. It's not a really good business to get into. I don't really like it as a business model because you're trying to like flip homes at scale. Seems like there's a lot of blow up risk inherent in that. Like if the market turns south, you have all this inventory. Just don't really love it. The Redfin CEO is just like a really good guy, seems very knowledgeable. Just like a guy you'd like to be running your money. In recent times, Zillow they did this whole iBuying thing. They seem to just have done it like really terribly. And they've since closed down that whole operation. I think they marked down like about, was it 900 million or so in homes that they marked down, and they sold it just like in bulk to private equity. I would definitely say questions are still to be answered on, is this iBuying even like a good business at all? Luckily, Redfin is very measured in their approach with iBuying. It's a pretty small portion. I think it's about 30% of revenues. If you look here, properties. So yeah, it's like about 30% of revenues or so. You can see here. So the real estate services, that is the brokerage business. That's like the really attractive business in my opinion. I think Redfin would tell you the only reason they're doing the iBuying is just to be like a one-stop shop type of option for the customer. And they're also getting into title, I think even some mortgage stuff. They're just trying to be like a real one-stop shop type of a deal. I am very interested because I think the value proposition is unmatched. There's not very many other offers out there that are offering you to pay less commission when you sell your home, which to me is very attractive. I don't think a lot of people are excited about paying 6% when they sell their home. Definitely falls into the category of it's a little expensive and it always has been. So you can see the revenue is growing steadily, probably on average about 40% per year. This is one that the financials, as being more of a value investor, are never really going to make sense, but it's more of I understand the value proposition and I know that it's a good one and I can just kind of bet on that. So the margins are not great, right? It's 26% pretty much consistently gross margin, and you're paying 2.5 times revenue. It's expensive. It's currently trading around $30. You can see here's the chart for the company over the past, this is a monthly chart, so since 2017. I'd definitely be a buyer like low 20s is kind of maybe what I'm waiting for. It had a big run up with all of the growth stocks and has since really come back down to earth. At the low 20s, you're paying about maybe like 2.8 billion in enterprise value. You're still not getting very much in revenue. So if we look, what's they've been doing this year? This year looks like 1.3 billion or so far this year. So yeah, they're going to have a good year. They're going to be at about 1.5 billion in revenue in 2021. So if you can pay, I think I'd be interested around 2 times sales. I really like the company. It's just the price is tough. Clocking in at number 4, we have Universal Music Group. So right now, this is by far my favorite company. I'm 100% convinced of the economics of how good the business is. It's just the price. I love the business model because the competitive advantage is so strong. They have all of this IP that they own that is just, it's timeless. So that you can't recreate it. They own it. No one else can own it. There's more so as far as like a going forward, developing new IP. That is where more of the competition is. But they have such a huge advantage built that you could go out 50, 100, 200 years. It's hard to really see Universal Music Group not having immense value. And anytime I have a company that the terminal value is just so strong, I like it. That's like the number one thing I look for. So companies like Coca-Cola, the value is just always going to be there. Nike kind of, but you can maybe see a world where Nike, with the ethical concerns and stuff, maybe that goes away a little bit. There's very few companies that you can look out 100 years and be confident they're still going to be around. This is one of them. UMG, it's traded on the Amsterdam exchange, so you're going to need a international brokerage account to purchase this. So it just recently went public via a spin-off from Vivendi, which was 80% owner, I believe, and I became aware of this company because Bill Ackman, Pershing Square, he has a SPAC, the Pershing Square Tontine Holding, I think it's called, PSTH is the ticker symbol. They were going to acquire or merge with this company, UMG. That was the original plan. That fell through because the deal had like too many complexities. The SEC vetoed it. So instead, Bill Ackman has actually purchased a 35% share, or at least his holdings. This is 35% of his holdings. He owns 10% of the company. 35% of his fund is now in Universal Music Group. He got a little bit of a deal on the purchase price from what I could tell. So that was like a little bit of an off-market deal because I think it was a private transaction with Vivendi, the original 80% owners of UMG. So it looks like Bill Ackman purchased it for 35 billion euro and 41 billion US dollars. And you can see it's currently a little bit above his purchase. So this is US dollars. It's about 47 billion enterprise value. So it's about, what is that, 10%? A little over 10% up from where Bill got it. But if you look at the chart, this is the monthly chart, it never really dropped down to Bill's purchase price. So it's currently trading at 22 euro. So really quick overview of what is going on with UMG. So basically I went down a rabbit hole of looking into Spotify for a while, and I was just like, I couldn't get over the fact of how low the margins are. Like Spotify, you imagine that they have all this operating leverage. When they get to scale, they just start raking in the money. But you know who's raking in the money is UMG. UMG is making all the money from this expansion. We're listening to more music these days. There's Spotify, there's TikTok, there's Instagram Reels, YouTube Shorts. There's increase in monetization of YouTube music. So they refer to this as ad-supported music. They're not getting the subscription royalty fee like you get with Spotify. It's ad-supported. And I know personally, like when I was making videos for my other channel about 5 years ago, I would put clips of music in it and UMG would be monetizing my video because they would have a copyright claim. So I'm working for UMG. in a sense. I think it's just a great, like, sort of a pick and shovel play on, I hate saying the word play because it's not a play, it's a long-term investment. It's really sort of a pick and shovel investment on the growth of social music, which is a big part of their revenues now. If I like to just use this ticker app and you look at the segment revenue, and they're really good. I don't know how they do this. They're taking these financial statements from Vivendi, which that's where you go to look at the historic financials for a Universal Music Group. So I have a lot of that kind of just broken out here. But if you just want a little bit of a quick picture here, this is the revenue. So revenue growth from 2013 to 2020, pretty solid growth. But the big thing here is the margins. Margins doubled from 2013 to 2020. And that in large part is because of the increased value of catalog music. So UMG has the biggest and best music catalog in the business. About 30% of like music that's listened to, catalog music that's listened to, UMG owns, and they will always own unless they start selling. And another big development is, like, you've seen there's these funds and these investment vehicles that are going out and purchasing catalog music now. So recently UMG purchased Bob Dylan's music catalog for $500 million. You can kind of see the value of all this stuff. So when you pay 35, 40 billion or whatever it is for UMG, you're getting a lot of that just in the catalog value. You have the earning power of the music over time, and the value, it's hard for me to imagine it really decreasing. Like music, you're basically just betting on music being either staying the same or having an increasing role in our lives. So it's a really safe long-term bet. The only thing is the valuation. And I think when you have such a steady income stream like this, the valuation matters even more because the variance of outcomes down the road is not that high. So you got to be more precise with your purchase. So it's looking like they're going to do about $8 billion in 2021. And if you imagine a 20% EBITDA margin, that is $1.6 billion. So you're getting about 1.6 billion in EBITDA, and you're paying, and that's euro. That's 1.6 billion euro in EBITDA. You're paying 42 billion. So you're paying 26 times EBITDA. It's expensive for sure. I don't know. It's one that I would love to buy. I want to buy. I have my eye on it. It's basically the number one company at this point I want to own. It's just, I think it's a little expensive. I think 20 times EBITDA is probably where I would like to be, which means a stock price of more like $18. 17, 18 range, I would be snapping it up for sure. Okay, this video is taking way too long. So number 3, Boston Omaha Corporation. This is a complicated one, so I'm going to try to just simplify it as much as possible. Essentially, you are betting on the 2 co-CEOs. That's the entirety of this investment. They write really amazing, incredible. A lot of people like them for this reason. They write great shareholder letters, similar to the way Warren Buffett does with Berkshire Hathaway. So a lot of people are thinking this company could turn into a Berkshire Hathaway type company over time. A lot of that is definitely like still to be determined, I would say. I'm highly interested. I like what they're doing. They seem to have a long-term mindset. They're someone I like having my money with. I have not invested in them yet, although the price is not terrible right now. So this is one that I'd probably be interested in near current prices. It's BOMN is a ticker symbol. And if you look at it through this lens, it's not really going to tell you much. So they became public in 2015. They've been adding long-term businesses over time. So right now they operate billboards. They have a cable fiber business in southwest United States, Arizona, Utah. They have an insurance business in which they use the float to invest, very similar to the way Berkshire Hathaway did in public equities. The big thing they've done recently is there's a SPAC, and it has acquired or merged with Sky Harbor. It's a little weird. They build hangars for private jets, and they offer like a membership service. It's not actually currently operational, though. They've just raised a bunch of money that they're going to be building these things, so that's really a long-term thing. But you can see sort of everything they're doing has an upfront cost, and then you just reap the dividends over time. So really, once this gets up and running, fully operational, everything's online, you can see that the income stream could be quite good. Some of my critiques is that the operational businesses so far have not been like super exceptional as far as the operating results. So they put a bunch of money in billboards. They're not getting a great return on them yet. The insurance business, not really a great return. It seems like the cable business is and does have the potential for a really good return. Some things they have done though that gives me some confidence is they invested in Dreamfinder Homes, which has recently, I think in 2020, went public, or maybe 2021. And they like 10x their investment in that in like 4 years or something. So seems like they have an eye and a knack for capital allocation, which is essentially their entire role at the company. Also, they've done some cool things where they purchased a cable business, and now they have a deal where Dreamfinder Homes is using that fiber company to service their newly built homes. So there's a lot of like synergies, and it seems like they just have a good network, good deal flow, and it's a rising tide lifts all boats type of thing. They're really building a good atmosphere. So overall, I'm monitoring this company very closely. It's probably on this list of ones that I have not bought yet, the one I'm closest to buying. And this is definitely one that will have an enduring competitive advantage, which is the ability of the CEOs. That's really what you're betting on. So very interesting company, real long-term investment. I'm interested. Next up, we have StoneCo, STNE, and this is a little bit outside of my typical wheelhouse. This is more of a rapid growth company, but the valuation is it's pretty appetizing. And as a disclaimer, I do own this stock. I actually recently purchased it. Maybe I'll go into that in a different video. It's not a big position. It's just a little starter monitoring position because the valuation was quite good. So what StoneCo does, you can think of it, and they've actually described it as like a combination of PayPal, Square, Stripe, all together. And it's operating exclusively, I believe. Maybe it's spreading a little bit, but it's mostly just Brazil. And their customers are medium and small businesses. They're looking to get to more of micro businesses, which there's another company called PagSeguro in Brazil, which really services the micro businesses. StoneCo is looking to get more involved with that. So Warren Buffett, Berkshire Hathaway is invested in this company. I don't think it was Warren Buffett. I think it was one of the underlings. I know there's like a few people at Berkshire Hathaway that are starting to make investments, and I don't think this was Warren Buffett. Kathy Wood, ARK Funds, is also invested in this company. So a little bit of like two polar opposites, both finding something about this company that they like. So they IPO'd in 2018. They are an American traded company. A lot of stocks have this very similar chart, especially if you're in any way a growth company. So they shot up to $95 and they've since dropped down to a low of about $13. My purchase price was $14. They're growing pretty rapidly. I'd say if you normalize this, maybe like 50% per year. Obviously, the bigger you get, it gets a little bit harder to grow. The margins are exceptional, almost 80% margins, gross margins. Operating margins are also exceptional. And what I actually love about them is they are a profitable company. So they're one of these few like hyper growth companies that is actually profitable. That's probably why I was able to pull the trigger on them. So they have some cash on their balance sheet. You can see about 500 million. That's the difference between the market value and the enterprise value. The 10-year median return on invested capital is decent for a growth company, and a lot of their metrics are pretty good. So you can see the revenue growth in 2020 was down a lot. A lot of that was COVID related. They've also had some like operational mishaps lately. Brazil's government, they created this thing called Pix. I think that's what it is, which is basically peer-to-peer like transactions. So the government is actually servicing a lot of those. So it kind of cuts into StoneCo's business quite substantially, although there are potentially some ways that it helps StoneCo in the long term. In general, I just like the fact that it's a growing business. They're a business that has shown time and time again that they can like quickly innovate and quickly execute. The founder and CEO seems to be a pretty good, smart guy. He started a bunch of different companies. I think he has about 20 years in the like financial sector. So a lot of the reason the stock's so cheap is Brazil's inflation. The government is a little bit uncertain. Inflation is high. There's an election coming up in 2022. It seems like the leftist candidate is going to win, which is typically not great for business. There were the operational mishaps, and when you just sort of combine all of those things, it seems to me like the underlying business is still on a good trajectory. It's just a lot of the headlines lately have been negative towards the company, so it looked like a good opportunity to me. And last but not least, we have my number one pick, and this is actually one disclaimer. I own a lot of it. I've been loading up on it lately. I don't like using terms like that. I'm trying to be like less promotional and like hype based, but I have, I guess, been loading up on it. So it is Boohoo. Most of my ideas come from super investors. I think I've told you guys this before. So how I came upon this idea was I was reading Nick Sleep. He has these Nomad Fund letters. Basically his fund from, I think, 2004 maybe to, I forget when it was. Maybe 2004 to 2014, about 10 years. His fund just completely crushed it. He basically shut down his fund and he was like, all you guys have to do is buy Berkshire Hathaway, Amazon, Costco. And he said that in 2014. And since then, obviously, if you've done that, you've done really well. But one thing he did was he sold a lot of his Amazon and he bought ASOS, ASC, on the London Stock Exchange. That was my original idea. I was like, okay, ASOS, let's look at this. What's going on here? I look at the chart for ASOS and I see, wow, this is the kind of chart I like to see. I'm like, oh man, we can maybe get a deal on this. Maybe we can even buy it for less than Nick Sleep bought it for. So I read through all of the ASOS annual reports and I was really into it. And then I went and I was like, okay, let me read some of their competitors and see what I think of them and how they are situated competitively in their industry. The main thing I didn't like about ASOS is the abrupt departure of their CEO recently. And that to me is a big red flag. Usually, if things are cordial, there's some sort of exit plan where it's like a gradual thing over the course of 6 months to a year. This was abrupt. The reason given was that the CEO couldn't commit to being here for the duration of the next 5-year plan that they were, getting going. And because he was hesitant, they just let him go immediately and they wanted to pursue someone else that could lead them for the next 5 years. And I didn't like the fact that the inside ownership at ASOS is really low. So the CEO, the founders, they barely own, I think the founder owns 2 or 3% of the company and he's not super active in the company anymore. So I don't like that. I like the inside ownership to be high. I like the founders and the operators to be running the show. Then I started looking at Boohoo. I read all of their annual reports and the inside ownership is extremely high. So one of the first things I look for always is inside ownership. It's not 100% essential, but it's like in 95% of my investments, I want there to be really strong inside ownership. And the co-founders are this man right here, Mahmoud Kamani, also Carol Kane. Those are the two co-founders, and they own a substantial amount of the company. And then you also have someone here in the family who owns a very high percentage of the company as well. So if you add all that up, you got 12%, you got close to 5%, 3%. You're looking at close to 20% inside ownership just in those individuals. And there's a few other individual investors that own a big percentage of it too. I got to reading the annual reports and I just liked it a lot more than ASOS. And the main difference, and I guess I'll tell you what the companies do. So they are fast fashion clothing companies. I don't know anything about fast fashion clothing. I have ordered from a bunch of them just to see the differences. So these are all the brands that Boohoo owns. And the major thing, the differentiator that Boohoo does relative to almost all the other competition, ASOS, for example, ASOS has one big website that they sell a bunch of different brands from. Some their own brands, some third-party brands. Boohoo has a bunch of different websites and a bunch of different apps that they sell a bunch of different brands. The same people making the clothes, the same people distributing the clothes, but the brands are different. So it's very modular, so they can easily plug a new brand into their machinery and get it up and running, which is what they've been doing. They've recently been taking advantage of a lot of brick and mortar retailers going out of business, buying them out of foreclosure, and revitalizing them and just putting them into their system, which we haven't seen the results from that yet, which I'm going to be monitoring very closely. But I like the Boohoo business model a lot. So their major brands. Boohoo is the original Pretty Little Thing. So this was started by the founder, his son. And there's a little bit of like inside dealing and how this all went down. I'm okay with it. I think when you're a family-run business, there's going to be a little bit of that, and it's better than the alternative, which is just like corporate run businesses. So essentially how it went down, and this is getting kind of long-winded, but his son started a business in 2015 called Pretty Little Thing. Boohoo in 2015 bought 66% of it for a really small amount, like $7 million, $10 million, something like that. And they had the rights to buy the last third of the business at any point. The business was building rapidly, and just last year they bought the rest of it for like $380 million. So they bought the last third for $380 million. So a lot of money. It is a really good business though, but they could have had that for significantly less. They could have bought it for, like a few $1,000,000. So Pretty Little Things is now, I think by now, it's either the number 1 or the number 2 business line in Boohoo. So they have all these different businesses. A lot of these they just recently bought and they're revitalizing. So why is the stock so cheap? That's a good question. Why has it dropped off a cliff in the past year or two? What has essentially happened is they had some like ethical worker violations. Basically, they weren't paying their workers in England minimum wage. I think it was in Leicester is how you say it. I always say Leicester, but I think it's Leicester. They were not paying their workers minimum wage. A lot of like under the table shady stuff. It's kind of what you would expect from like a founder family run business. And I've seen some interviews with the guy, the founder. It's kind of why I'm really into this company. He's just like a cutthroat, like, win at all costs type of a guy. He's the type of guy you want to bet on. He's definitely going to bend the rules in the future, in the past, probably done tons of unethical things. That would be my guess, but he's the type of guy you want to have your money with. He's going to win. More recently, they revised their future estimates downwards quite substantially. So these are all their acquisitions. I have just a lot of shorthand stuff here. Yeah, I think they have it right here on their site. Yeah, they do. Okay, so you can see this is their track record over the years. So their EBITDA margin has hovered between like 9.5% and 10.5%. And they have since guided 2022 EBITDA margins to be between 6 and 7%. So that's a pretty big haircut. A big reason for that, they are saying, is the freight costs. And a big differentiator between them and a lot of these other big scale fast fashion retailers, they do everything from England. So all of their shipping comes from England. So there was Brexit, which has complicated things a little bit. Their freight costs have gone up like 400 or 500%. So they're eating a lot of the additional costs, not passing as much of it on to their customers, which I think is a good move. And in 2023, they're going to have a fulfillment center in the US, which is I think about 30-40%. US is... Yeah, it's like 25% of their total sales. So they're getting a fulfillment center in the USA in 2023, which should cut down on their freight costs. It's sort of a situation where it seems like a lot of short-term pain, long-term gain. It's a good opportunity to get into it, at least in my opinion. Quick glance at the financials so you can see they have cash on the balance sheet. Enterprise value, $1.1 billion. This was up to like $6 billion previously. So you're getting a great deal. Price to earnings, 22 price to earnings on a company growing at about 40%. So everything, EV to sales, 0.6, EV to EBIT, 13.1, the acquirer's multiple. This is trading like a company that's not growing very much at all. A lot of the reason for the discount, like I said, all those other factors, plus it's only traded on the London Stock Exchange. You get a little bit of a European discount relative to U.S. companies. U.S. companies right now and typically for the last like 20 years have traded at a premium. So this one to me is by far my number one place I'm deploying money right now. It seems like a slam dunk. Just looking at this, 20% return on invested capital, 21% return on equity over the 10-year average. It's just, some of it is obviously like this 2014, they have just crazy high numbers, which is sort of weighing it to the upside. But man, it's just consistency. Seems like a machine. That's what I keep running through my head is like, how would this lose for me? And a few of the reasons are something catastrophic with the founder, like going to jail. I could see that. Fashion cycles in ways that I don't fully understand. So maybe they could just fall out of favor, but they have so many different brands that it seems like they're isolated from that to some degree. It's pretty tough for me to see you losing with Boohoo. So for that reason, it is my number one investment idea at the moment. Comment down below. Let me know what you guys are looking at this month, and thanks for watching.